The sovereign gold bond, or SGB as it's commonly called, is now a popular mainstream way of investing in gold for lakhs of Indian consumers. In numbers, over 60,000 crores of these bonds have been issued by the RBI, which when converted into physical gold comes to about 130 tons of it. In fact, the first tranche, which was issued in 2015, turned out to be a super hit, with subscribers not only enjoying a 2.75% fixed annual interest rate, but also a nice appreciation in the price of gold, which gave them a total return of 12.9% over the last 8 years, with a large part of it being tax-free. So look at it this way, we Indians love gold. We love the returns we receive on it. After all, 12.9% is pretty good. We love the fact that we don't have to pay much tax on SGB, and if there's something that we love even more, it is to buy gold at a nice big discount, which is what this video is all about. So let's begin. Alright, so this might come as a surprise to some of you, but sovereign gold bonds are more of a bond and there is no real gold in it. I'd explained this in a previous video, but just to recap, the unique and surprising thing about SGBs is that these are not backed by any physical gold, which means they're merely a promise by the government of India that at the time of maturity, these bonds will be redeemed at the then prevailing gold price. So essentially, an SGB is nothing but a simple market-linked derivative instrument that comes with a sovereign guarantee. It is also interest-bearing and subscribers receive a 2.5% annual coupon, which earlier used to be 2.75. The maturity proceeds are tax-free if held until maturity, while the interest is taxable as per existing tax laws. One can invest as low as 1 gram worth of gold. And while the sovereign gold bond have an 8-year tenure, the RBI does allow partial withdrawals via early redemption windows. Now, there are a couple of ways of investing into an SGB. The first approach is pretty straightforward, and it is to buy some grams of gold from your bank or post office when the RBI opens up the next buying window. This is how a majority of consumers buy, and the 60,000 crores I mentioned at the start of the video is a part of that. The second approach, and something that I'm more interested in, is to buy gold bonds from the secondary market using your trading/demat account. You see, one of the SGB's unique features is that these bonds are tradable on the Indian stock exchanges. So presently there are 64 SGB issues that are listed, and just by looking at the stock symbol, one can figure out when the issue is due for maturity. For instance, SGB NOV24 is a clear tell that the issue is expiring in the year 2024 in the month of November. Now, the fun part is that these SGBs often trade at a discount to the prevailing gold price, and at the time of recording this video, while the November 2024 issue was trading at 6,550 rupees per gram, the actual price of gold was about 6,640 rupees as per IBG's website. IBG is standing for the Indian Bullion and Jewellers Association, which means these bonds at that moment were trading at a discount of 1.4%. So 1.4% is a good start, but with 64 different issues of SGB floating around, it is not uncommon to find even deeper discounts. For example, this one here, the tranche that's maturing in June of 2030 is available at 6,378 rupees per gram, which comes to a 4% discount on today's price of gold. Now, the obvious question in the mind of gold diggers, figuratively speaking, is that instead of investing in newly floated SGB tranches, is it a better idea to wait for discounts and to buy them from the secondary market? And speaking of discounts, how about this one from Mstock, the sponsors of this video and one of the few stockbrokers in the country that have built a zero brokerage model. Yep, you heard it right, zero brokerage. Which means there's free intraday, free delivery, free F&O, free mutual funds, free IPOs, and a lot more. And all of this can be yours by paying an account opening charge of just 999 rupees. Yes, just 999 for all this free stuff. And if you pay another 999, then you can also get rid of those quarterly AMC charges for the rest of your life. In fact, the Mstock website has this detailed comparison table, and if you're someone who is into intraday, uses futures and options, does margin trading, which incredibly at Mstock can be as low as 6.99%, then definitely check out Mstock, as it will help you save a lot of money. But money isn't everything, right? Equally important is trust, and pleasantly, Mstock is backed by the Mirae Asset Group, which needs no introduction. It has over 8.5 lakh users. It did over 4 lakh crores of turnover and is estimated to have saved 145 crores in brokerage last year. So save it, trust it, compare it, and don't forget to try it. As always, the link to this platform is available in this video's description. And now let's get back to that question on whether one should invest in a new SGB tranche or it's better to buy them from the secondary market. Well, it's more complicated than that, because while there is a discount most times, it's also true that many of these SGBs trading on the stock exchanges have very thin volumes, and sometimes it might be difficult to find a buyer or seller to trade with. For example, the screenshot I showed you on the November 2024 bonds had a today traded value of just 3 lakh rupees, which means if you had 60-70 grams of gold to sell, then you're likely to be in a bind because there aren't enough sellers to buy that much of gold from you. But having said this, what I've generally observed is that the late maturities, that is bonds which are maturing in 2029, 30, 31, etc., generally those bonds tend to have better volumes as compared to closer maturities like the ones that are maturing later this year or the next year. It's an important consideration, so do keep volumes in mind. And related to volumes, a good way of operationalizing the investing exercise is to examine the bids and offers section on your trading platform or on the NSE website. Like in this case, if you're looking to buy a bond for say 6,400 rupees, then you're likely to come up empty-handed, but an understanding of this report not only lets you know what price the sellers are looking for, but it also helps you determine where the sweet spot is and how low the sellers can go. And the fourth area one needs to consider when evaluating bonds in the secondary market is the interest payment schedule. So imagine you are offered these two bonds. Both these bonds are expiring 6 months from now. They will pay you a maturity of say 100 rupees. Both are currently priced at 95 rupees. However, the second bond, bond B, has a quarterly interest amount of 2 rupees that's still payable on it. Now you tell me, is it more beneficial for you to buy bond A or to buy bond B? Well, no marks for getting that right. It's definitely bond B, and because a sovereign gold bond is also an interest-bearing bond, the interest entitlement part has to be always kept in mind. Another related point is on the percentage of interest, and taking the example of SGB November 2024. When it was first issued in 2016, the issue price was 3,007 rupees, and it is on this price that the 2.5% fixed interest rate is calculated, which comes to 75 rupees and 17 paisa per gram of gold. Now, if you're buying these bonds today at 6,550 rupees, then the effective interest rate is not 2.5%, but it's more like 1.15%. So always keep that in mind. Okay, so there are too many things to consider here, which means we need some kind of automation, something that can fetch the current value of multiple sovereign gold bonds, extract the gold prices, incorporate future interest payments, compute the present value, the future value, and of course, indicate to investors like us if buying an SGB and which SGB is likely to be a profitable deal. Now, thankfully, there is a solution to this, a free platform called SGB Analyzer that was developed by Mr. Amit Wani, and what it does is that it takes all the active SGBs in the market, does some computations, and presents those data points in a simple tabular format. Some of the columns are pretty standard, so things like when the bond is expiring, the residual period, that is the time to maturity, the interest rate, some data on volume, etc. But then pertinently, the platform also looks at some key values like the present value of all future interest rate payments, and the discount rate or the hurdle rate that Mr. Wani has used for this is 6%. So as an example, our November 2024 bonds are expiring on the 17th of November, which means there are two interest payments remaining of 37.59 rupees each. These are payable on the 17th of May and on the 17th of November respectively. And when a present value function is applied to it, it totals to 71.92 rupees. Of course, different SGB issues have a different present value number depending on, firstly, the interest amount payable, that again depends on the percentage and the issue price. Secondly, the number of payments, and of course, on which dates these payments need to be made. So thankfully, this platform does all this work for us, and what it also does is that it calculates the fair value of the bond, which is derived by taking the present value of interest payments, which we just calculated as 71.92 rupees, and adding it to the current price of gold, which is fetched from the IBGA website, which is 6,680 rupees currently, and as a total, this comes to a fair value of 6,754 rupees and 92 paise. The next step in this table is to look at the ask price, which is the lowest price at which a seller is ready to redeem his or her units, and it comes to 6,650 in our case, which means there is a potential discount of 104 rupees and 92 paise from the issue's fair value that computes to a discount of 1.55%. Now, a discount of 1.5% doesn't seem impressive, but as we have discussed earlier, this number is low because the bond is close to the date of maturity. But when I sort the discount to fair value column, one can see discounts of almost 16% on SGBs which are maturing in 2031 and 32, and a whole bunch of them are available at a 3 to 4% discount to the current price of gold. Again, what's interesting here is that this tool does not consider any future appreciation in the price of gold. This is not a flaw in the model, but it's actually an upside. And if I add the long term, and by long term, I mean the last 20, 25, 30 years of price growth, then gold has appreciated by about 10%, and thanks to the interest component, which gets captured in the total yield to maturity column, we are probably looking at a 12 to 12.5% return on a pre-tax basis. On a post-tax basis, and because taxes are charged only on the interest component, and assuming you're going to keep these bonds until maturity, then we're looking at about 11.5, 11.7% kind of returns from the data we have in front of us. I'll certainly encourage you to try out this tool. Do go through the FAQs that Mr. Vani has compiled for everyone's benefit. And whenever you're purchasing gold, do have SGB buying from the secondary market in your consideration set. So to recap, here's how one can look at it. In box A, we have physical gold which one can buy at market price, let's say at 100 rupees per gram of gold. In box B, we have gold ETFs and mutual funds, wherein the investor receives only the capital appreciation and there are taxes to be paid when redeeming those units. Box C are the SGBs that you buy when the RBI comes out with a new issue or tranche, and again there are no discounts per se other than the 50 rupee discount that's given for online buying. And finally, there's box D that has been the topic of my presentation today, which has an interest component to it. There are good chances of capital appreciation, and most presently, we can have them at a discount, which according to the SGB analyzer can be as high as 4% of the current price of gold. Or if we choose to look at it differently, after incorporating the present value of interest payments, it comes to a discount of 15-16% as compared to box A. Another suggestion I'd like to put forth is to invest in SGBs via the secondary market only if you're willing to hold these bonds until their maturity. And I say this for two reasons. Number one is, of course, taxation, and depending on your holding period, some capital gain tax will be applicable. As I've always said, I'm not good with taxes, so please consult your tax advisor or someone who does this for a living. And secondly, when you try to sell bonds prematurely, just like how you bought an SGB at a discount, you'll also have to sell it at a discount, which might negate your advantage. So to the extent possible, try to hold these bonds that you've bought from the secondary market, or if you buy them in the future, until their maturity date. Actually, you know what? Let me spend a minute on taxation, and the usual question everyone has, and even I had, was that what are the tax implications if I purchase SGBs from the secondary market and I hold it until maturity? Now, I searched high and low for the answer, and the most confident article I read on this came on Mint, where a few experts have said in the lines of, if an individual buys an SGB from the secondary market and redeems it on maturity, then there should be no capital gain tax implication in the hands of that individual. In addition to taxes, an investor should also take into account incidental costs like the brokerage, STT, SEBI charges, GST, etc., which have to be netted off when calculating your final returns. So there is some mathematics involved in everything we have discussed today, but keeping track of these values can give long-term gold investors a little extra. And just a few months back, the discount to fair value number, which is 15-16% currently, was as high as 22%. One can think of this more like an arbitrage situation and something all gold investors should take advantage of, or at least consider during one's evaluation of different gold products. If you found this video useful, then do tap the like button, do share it with your friends, and I'll see you very soon. Until then.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.